All right, so you sent over a whole bunch of research on Uber. Looks like you're really trying to get a handle on their position in the ride-hailing world, especially with all this talk about autonomous vehicles. We're talking analyst notes, financials, even their ESG risk rating.
All right.
This is quite a deep dive.
It is. It's a fascinating time for Uber. I think they're essentially standing at the intersection of tech and transportation and this looming autonomous future,
Right. Well, let's kick things off with what the analysts are saying. We have this Morningstar report from December 2024, and their analyst, Mark Giorelli, he seems pretty optimistic. I mean, he assigns Uber a narrow moat rating. Now,
Yeah.
I know that might sound like we're talking about medieval economics, but it actually means he believes Uber has a sustainable competitive advantage. What exactly does he see as their strength?
Well, he points to Uber's dominant market share. They control about 80% of the ride-hailing market in North America. And that's a significant advantage, especially when you consider the potential of autonomous vehicles. In fact, he actually downgraded Lyft to a no-moat rating, specifically because he believes they're ill-equipped to compete with Uber in the autonomous space.
Oh, wow. So he's essentially saying Uber is better positioned to capitalize on the AV revolution.
Exactly. And a big part of that comes down to what Giorelli calls the network effect.
Okay.
You can think of it like this: the more riders Uber has, the more drivers they attract.
Right.
That leads to more data, which allows them to refine their pricing and improve their service.
Yeah.
It creates this virtuous cycle that becomes very difficult for competitors to break.
Yeah, it's almost like a self-reinforcing loop, right? Like
Yeah.
the bigger they get, the better they get, and so on and so on.
Precisely. And there's some interesting data in this report from New York City that illustrates this, is that Uber's been steadily gaining market share there and even charging more per mile without losing customers. That's the power of the network effect in action.
Wow. So now all that sounds really promising for Uber's future,
Yeah.
but I'm sure there are some naysayers out there. What are the bears saying about Uber's prospects?
Yeah. Well, the biggest concern seems to be the possibility that AV companies like Waymo or Tesla could eventually decide to create their own ride-hailing apps.
Oh, okay.
If that happens, it could potentially cut Uber out of the equation entirely.
So instead of partnering with Uber, these AV companies could become direct competitors.
Exactly. That's a major risk factor that investors are watching closely.
Right.
There's also this ongoing concern about the regulatory landscape, specifically around the classification of gig workers. If drivers are reclassified as employees, it could significantly impact Uber's cost structure and eat into their profitability.
Right. That whole debate about gig workers has been swirling around Uber for years.
Yeah.
Speaking of profitability, one thing that struck me in this report is that Uber actually achieved GAAP profitability back in 2023 and is projected to remain profitable through 2024 and beyond. Remember those early days when they were burning through cash like crazy?
Oh, yeah. It's a remarkable turnaround for sure.
Yeah.
They've managed to optimize their operations and find a path to sustainable profitability. In fact, Giorelli is forecasting 15% annual revenue growth for Uber over the next 5 years.
Wow. So where is that growth coming from? Is it all ride-hailing, or are there other factors driving that projection?
Well, it's definitely a multi-pronged approach.
Okay.
They're seeing strong growth in international markets.
Yeah.
They're expanding into e-grocery delivery with things like Uber Eats for groceries.
Right.
And their freight logistics business is also gaining traction.
Interesting how they're diversifying their revenue streams. So it sounds like the financials are looking pretty solid overall. But Morningstar also assigns Uber a very high uncertainty rating. What's driving that, aside from the autonomous vehicle question mark?
Yeah, the AV uncertainty is definitely a major factor.
Right.
But there are other potential headwinds.
Yeah.
There's the question of how a transition to electric vehicles might impact driver supply. And of course, there's always the looming possibility of regulations changing the game for gig workers.
Yeah.
It's a pretty volatile landscape right now.
Okay, so we've got a company with strong financials, a seemingly solid position in the market, but there are also some significant uncertainties hanging over their future. What's Morningstar's overall take on Uber as an investment?
Well, Giorelli assigns them a fair value of $79 per share, which, considering they're currently trading at $64.59 as of January 3rd, 2025, suggests there might be a buying opportunity for investors.
Interesting.
But he also emphasizes that Uber is operating in a highly dynamic and unpredictable environment, which is reflected in their very high uncertainty rating.
Makes sense. So we've got the analyst's take on their economic moat, their fair value estimate, and a glimpse into the profit drivers. But what about how Uber is actually using its capital?
Well, Morningstar gives Uber a standard rating for capital allocation.
Okay.
Essentially, it means they're not making any groundbreaking moves, but they're also not making any egregious errors.
So a middle-of-the-road assessment. Can you give us some specific examples of their capital allocation decisions?
Sure, they've been strategically divesting from certain subscale operations that weren't performing well and reinvesting those funds in market leaders like Didi and Grab.
Right.
Remember their foray into developing their own autonomous vehicle technology?
Oh, right. Yeah.
They sold that off to Aurora back in 2020, but wisely retained a 25% stake in the company.
So they're still keeping a finger in the autonomous pie, even though they're not building the technology themselves anymore.
Exactly. And of course, they've also implemented a substantial $7 billion share buyback program, which signals confidence in their future prospects and a commitment to returning value to shareholders.
Interesting. So it seems like they're trying to play it smart, balancing growth investments with strategic divestitures and shareholder returns. I'm curious to hear more about their business strategy and outlook, particularly in light of this looming autonomous vehicle revolution.
Well, that's where things get really intriguing. On the one hand, you've got the bulls who believe Uber is perfectly positioned to become the dominant player in the autonomous ride-hailing market. They point to Uber's massive network of riders and drivers, their sophisticated pricing algorithms, and their experience in managing large-scale transportation operations as key advantages.
So essentially the bulls are saying Uber is already built to handle the complexities of autonomous ride-hailing.
Right. They argue that Uber's existing infrastructure and expertise will give them a significant edge over AV companies trying to build their own ride-hailing networks from scratch.
But what about those concerns we talked about earlier, like AV companies creating their own apps and potentially cutting Uber out?
That's where the bears come in.
Right.
They see Uber's dependence on partnerships with AV companies as a potential vulnerability. If those partnerships sour, or if AV companies decide to go it alone, Uber could find itself in a precarious position.
Okay, so we got a classic bulls versus bears scenario here. What are some of the specific arguments each side is making? Let's start with a bullish case for Uber. What are the key points they're emphasizing?
Well, the bulls are really leaning into this idea of demand aggregation. They argue that Uber is already a master at managing the peaks and valleys of demand in ride-hailing, especially during rush hour and other high-traffic periods.
Yeah.
They have this vast network of drivers who can come online when needed, and their algorithms are constantly adjusting prices and wait times to try to balance supply and demand.
So they're saying Uber has a proven system for handling the very problem that AV companies would struggle with if they tried to go it alone.
That's the core of their argument. They believe that Uber's experience with demand aggregation gives them this unique advantage in the AV space.
Right.
Imagine a future where you have entire fleets of autonomous vehicles that need to be coordinated and dispatched efficiently across the city.
Yeah.
It's a logistical nightmare, but it's a problem that Uber is already tackling on a daily basis with human drivers.
That's a really interesting point. It's like they've been unknowingly preparing for the AV revolution all along. But let's play devil's advocate for a moment. What if these AV companies get really good at predicting demand? Maybe even better than Uber. Couldn't they eventually develop their own sophisticated algorithms and cut out the middleman?
It's certainly a possibility. AVs generate a massive amount of data, and that data could potentially be used to create incredibly accurate demand forecasting models.
So Uber's advantage might not be as ironclad as the bulls believe.
It might not, but even if AV companies crack the demand code, they'll still face the challenge of managing their fleets.
Right.
Things like charging, cleaning, maintenance, repairs, all of that needs to be handled efficiently and at scale. And this is where Uber's other strengths come into play.
Okay.
They've already been building out their fleet management capabilities, both through their own efforts and through strategic acquisitions.
So even in a world where AV companies can predict demand perfectly, Uber could still be a valuable partner by providing the infrastructure and expertise to keep those AV fleets running smoothly.
Exactly. They could essentially become the operating system for AV ride-hailing, even if they're not the only app in town. And that brings us back to their financial performance.
Right.
They're generating significant profits, and those profits can be reinvested in further expanding their fleet management capabilities, strengthening their position in the AV ecosystem.
It's starting to sound like Uber might be a bit of a hybrid company straddling the worlds of tech and transportation.
Yeah, that's a great observation. They're not just a software company anymore. They're becoming this full-fledged logistics powerhouse. I mean, they're managing this vast network of drivers. They're experimenting with drone delivery. They're building out their freight logistics business. It's all interconnected.
It's like they're weaving together this intricate tapestry of transportation services, and autonomous vehicles are just one thread in that larger design. Okay, so we've explored the bull case, we've poked some holes in it, and we've looked at how Uber might adapt to a future dominated by AVs. Now let's turn our attention to the bears. What are their main concerns about Uber's long-term prospects?
Well, aside from the AV companies potentially becoming direct competitors, the bears are also worried about the regulatory risks we touched on earlier.
Right.
The whole gig worker classification issue is a major concern. If governments start forcing Uber to classify their drivers as employees, it would dramatically increase their labor costs and potentially wipe out their profits.
Right, that's a significant threat that could upend their entire business model. Are there any other regulatory hurdles they might face?
Another concern is this push towards electric vehicles.
Okay.
Many cities are implementing regulations that favor EVs, and some are even mandating a complete transition to electric fleets within a certain time frame. This could impact Uber in a couple of ways.
How so?
First, it could reduce the supply of drivers. Not all drivers will be able or willing to switch to electric vehicles, especially if it involves upfront costs or limitations on where they can charge.
Yeah.
This could lead to longer wait times and potentially higher prices for riders, which could in turn hurt demand.
That makes sense. It's like a ripple effect that starts with regulations and ends with a potential impact on Uber's core business. What's the other potential impact of the EV transition?
The other impact is on Uber's costs. Managing a fleet of electric vehicles is different from managing a fleet of gasoline-powered cars. You got to consider things like charging infrastructure, battery replacement costs, and even the electricity rates in different markets. All of this adds complexity and potentially eats into their margins.
It almost seems like they're caught between a rock and a hard place, right? On the one hand, they need to adapt to this changing regulatory landscape and embrace electric vehicles. But on the other hand, doing so could introduce new costs and challenges.
That's a great way to put it. It's a delicate balancing act for Uber. They need to find a way to navigate these transitions without jeopardizing their profitability or alienating their drivers.
So we've got the AV question mark, we've got the gig worker conundrum, and now we've got the EV transition, adding another layer of complexity. What's the overall takeaway here? Is Uber doomed? Or do they have a fighting chance?
I wouldn't say they're doomed, but they're definitely facing some formidable challenges. I think it comes down to execution.
Okay.
They need to make smart decisions about how they partner with AV companies, how they manage the transition to electric vehicles, and how they address the ongoing concerns about gig worker classification.
So it's not just about having a strong market position or a robust financial performance. It's about being nimble, adaptable, and making the right strategic moves in a rapidly evolving landscape.
Exactly. It's about thinking long-term, anticipating potential disruptions, and having a plan to address them. And that's where things get really interesting for investors, because trying to predict the future of a company like Uber is like trying to predict the weather.
Yeah.
There's so many variables at play.
It's a high-stakes game for sure.
Yeah.
And speaking of stakes, we haven't even touched on Uber's ESG risk rating yet. You mentioned earlier that they have a medium rating. What exactly does that mean, and how does it factor into the overall assessment of Uber as an investment?
Well, ESG stands for environmental, social, and governance, and it's become an increasingly important factor for investors who are looking for companies that are operating responsibly and sustainably.
So a medium rating means they're somewhere in the middle of the pack.
Essentially, yes. It means they have some work to do on certain ESG factors, but they're not considered a high-risk company. It's interesting to note that while their overall company exposure to ESG risks is considered medium, their management of these risks is actually rated strong.
So they're aware of the challenges and are actively trying to address them.
That's what the data suggests. For example, they've set ambitious goals for reducing their carbon footprint, they're investing in driver safety and well-being programs, and they've been making strides in improving their corporate governance practices.
It sounds like they're taking ESG seriously, which is a positive sign for investors who are factoring these considerations into their decisions.
Absolutely, and it's important to remember that ESG is not just a box to be checked. It's about integrating responsible business practices into every aspect of a company's operations.
Okay, so we've covered a lot of ground here. Analyst opinions, financial performance, potential risks, capital allocation, and even their ESG rating. What stands out to you as the most crucial takeaway for our listener who's been digging into all this Uber research?
I think the most crucial takeaway is that Uber's at a crossroads. I mean, they've built this incredibly powerful platform with these network effects that are really tough to replicate, and they're turning a profit. But the rise of autonomous vehicles represents both an incredible opportunity and a real existential threat. How they navigate this technological shift will determine if their narrow moat widens or disappears entirely.
Yeah, you're right. And a key factor in that will be their partnerships with AV companies. Will they be able to leverage their existing network to become the dominant player in the AV ride-hailing market, or will they get squeezed out by these new entrants? I mean, this is something investors should be watching closely. If Uber can secure deals with major players like Waymo or Tesla, that's a strong signal. They're on the right track. It shows these AV companies see them as a valuable partner, not just a competitor. You're right, those partnerships will be crucial. But even with solid partnerships, this transition won't be easy. How they handle the practicalities of managing a massive fleet of autonomous vehicles will be just as important as those high-level partnerships.
Absolutely. And that's why investors should also be keeping a close eye on Uber's fleet management capabilities. Are they investing heavily in this area? Are they acquiring companies with expertise in things like charging infrastructure and maintenance? Are they developing innovative solutions for the unique challenges of managing an AV fleet?
Yeah, because if they can build a robust and efficient fleet management system that gives them a major competitive edge, even in a world where AVs are everywhere.
Precisely. It could make them the go-to partner for AV companies, even if those companies are also developing their own ride-hailing apps. Think of it like this. Even if Apple makes the iPhone, they rely on this vast network of carriers and service providers to make it all work. Uber could become that essential backbone for the AV ecosystem.
Okay, that's a pretty compelling analogy. So I've got partnerships and fleet management as key areas to watch. What about their financials? Are there specific metrics investors should be paying attention to as this whole AV revolution unfolds?
Well, as we discussed, they're already profitable and their margins are expected to expand significantly in the coming years. But investors need to watch those margins carefully. If they start to shrink, it could be a sign they're struggling to adapt to the changing landscape. It could indicate their costs are rising faster than their revenue, or that they're having to sacrifice profitability to compete in the AV space.
So keeping an eye on those margins can give investors a sense of how well they're managing this transition. Any final thoughts you want to leave our listener with?
I think the biggest question that remains unanswered is how this shift to autonomous vehicles will impact the overall ride-hailing market. Will it expand the market by making ride-hailing more accessible and affordable? Or will it lead to consolidation as AV companies and ride-hailing platforms battle for dominance? That's something we'll all be watching closely in the years to come.
All right, folks, that wraps up our deep dive on Uber. Hopefully this is giving you some valuable insights into this company that's standing at the very edge of a potential transportation revolution. If you're hungry for more deep dives into the world of finance and business, don't forget to subscribe to our channel. And if you're ready to start investing, check out the show notes for a special offer from our sponsor, Robinhood. They make it easy and affordable to invest in companies like Uber and many others. Plus, we've curated a list of insightful books on business and finance available on Amazon. Find the link in our show notes. That's it for us today. Thanks for joining us on The Deep Dive.